your presentation skills, your confidence, and your comprehension or the clarity. So these are the four criterias on which you'll be judged. Okay, so we can begin. So team one is Anisha and Ashutosh. So Anisha and Ashutosh, you can start presenting your screen. And remember to switch on your cameras. Guys, am I audible?
Yes, can you just give us like 1 minute?
Okay, sure.
Yeah, hello. So, am I audible?
Yes, yes, you're audible, Ashutosh.
Okay, just give me a minute. I'll, so, my presentation, is it visible to everyone?
No, no, your screen is not visible.
Okay, just give me a minute. Is it okay?
Yes, yes, it is visible now.
Okay. So, we all heard the term about risk, return, and trade-off in finance, right? So, what are these terms? Basically, in today's presentation, we are going to just going a little bit depth about all of these terms. So, having a bit of technical issue. Just give me a minute. So, the presentation, is it visible to everyone?
Yes, it is.
Yes.
Just give me a minute. Okay. Okay. So, if you know this person is called Gary Cohn. He's an American investment banker and an American businessman. So, in all his quotes, he will be mostly telling about the risk management, in which he says that if you don't manage the risk, it doesn't matter what kind of business you are, but it will always be a risky business and there will be high chances of failure. So, from next, we are going to uh, so in the next slide we are going to discuss what is risk. So the any investment related uncertainty that has the potential to have a negative influence on our financial well-being is referred to be a risk. So for example, we can say that market risk might cause your investment value to increase or decrease. It always depends on the market. So we have to be so we have to check the market value before investing into some certain kind of sectors. So uh, risk are generally divided into two parts. One is called the systematic risk, and the second is called the unsystematic risk. So in systematic risk, it is a type of risk which you can't avoid, no matter how many diversification you do in your portfolio. It is a type of risk that is in a macro economic sector, so it can't just be avoided. Whereas the unsystematic risk are a type of risk which can be avoided as it is in a micro area. So under the systematic risk, there is a risk called the interest rate risk. So the interest rate risk is the possibility of investment losses brought by an increase in the going of rate of interest. Uh, okay. So, for example, if the interest rate increase, the secondary market value of a bond or the other fixed income investment will increase or decrease. So, in the next slide, which is the price risk refers to the chance that the value of a securities or investment portfolio will decrease for a variety of reasons other than a market downturn. The price risk is the chance that a securities or investment value will fall. Earnings volatility, bad business management, and price variations are the factors that can influence the price risk. So moving on to the next slide, reinvest rate risk. So it is generally termed as once the investor has invested some kind of investment in a portfolio, he cannot turn or change that investment again into the secondary investment. The reinvestment rate is in the name given to this new rate. Uh, Okay, so there are some key lessons. Reinvestment risk is the possibility that cash flows from one investment would perform worse when used in another. The second point will be because callable bonds are frequently redeemed when the interest rates fall. They're particularly susceptible for reinvestment risk. Moving on to the next slide, what is a market risk? Market risk is nothing but the chances that you invest x amount of money. If the market is not doing good, there's a high chances that the investment will fall. It generally in these kind of scenarios, your investment depends upon the market. So you need to be wise that the investment you are doing has the right market time. So moving to the next slide, what is a volatility risk? Volatility risk is the risk that the value of a portfolio will fluctuate as a result of changes in the risk factor volatility. If the volatility of underlying is a substantial influence, it often applies to the derivative instrument portfolios. For example, the stock market is said to be volatile when it fluctuates by more than 1% over an extended period of time. So the second one is cost inflation risk. The danger of inflation undermining an investment profits by causing fall in buyers' power is known as inflationary risk. Because the bonds payout are typically dependent on the fixed interest rate, which means an increase in inflation reduces their purchasing power. They are particularly susceptible to inflation risk. So next is the demand risk. Demand risk is the possibility of suffering a loss as a result of disparity between anticipated and actual demand. Demand predictions are frequently used as the foundation for choice about supply chain management and capital investment. When the predictions are wrong, it may lead to the losses or subpar performance. So, for example, we can say that if you are manufacturing a product but there is no demand for it, and you are just sending it to the market, there's a high chances that it will fail. So, purchasing power inflationary risk is the danger of declining purchasing power is the chance that you won't be able to spend the money as much in the future. It symbolizes a decline in value bought by the inflation. For example, consider investing in government bonds that have a set of return of 5%. When you purchase the bond, the inflation is at 2%, but over time it starts to rise over the year. So next we are going to discuss about the absolute risk. So basically these risks are the type of risk which are there. You cannot just avoid it. It means absolute risk is the real.
Ashutosh,
Okay,
just a second. Actually, you are running out of time, and Anisha, you haven't spoken anything yet.
okay. I'll just conclude to the last part. So these are okay. I'll just tell a little bit of summary of every slides in a small time. So
Like,
unsystem.
has Anisha created another PPT or
No,
what?
no, it's in the
No, it's
same.
in continuation. Yeah,
Okay,
he's
fine.
explaining risk and return. I'll explain trade-offs.
Okay, fine. So you guys are running out of time. So let Anisha speak.
Yeah,
Fatima,
yeah, sure.
Fatima. Let him go, let
Yes.
him go, let him go. Let him go.
Okay,
Ashutosh,
fine.
continue.
Okay, okay, fine.
Ashutosh, you can continue
Okay,
the
I will
part that you were
continue.
covering about. Yeah, you can continue.
Okay. Just give me a second. I
Just
okay.
a thing, do not read your PPT. PPT is never meant to be read. PPT is just, just to take some, what I can say, some pointers, but you have to explain things that are written there on your own. So that's one. Good.
Okay. So I'll just wait it. Okay. So I'll continue to unsystematic risks. So these are the risks which are basically happens within the organization. So you can manage it with proper management and proper guidance. This can be avoided, and under this, it's called the business risk. So any exposure business or organization has the elements that could reduce its earning or force into bankruptcy is referred as a business risk. So to the next slide, asset liquidity risk. So it is a type of risk in which the asset can be liquidated within a certain period of time. So that is generally called the asset liquidatory risk. If we continue to the again same thing goes for the funding liquidatory risk. Instead of the asset, in this part, it is just the funding part, and then comes the financial. So we can define it for by an example, a borrowed credit line variable such as the present debt burden, income, and lender can reduce credit risk. Second, so if we move to the exposure rate risk, this is the likelihood of a risk incident occurring in often multiple by the sum of potential losses to determine the level of exposure. So, to moving in the next slide, this is the recovery rate risk. So, recovery rate risk is where the investor has invested some X amount of money, and there is a recovery rate risk that he has to manage. He or she has to manage. So, this is basically a synopsis of that one. And so I'll just move a bit faster. It's very lengthy slides. So sovereign risk is a risk where, so first say I'm an investor and I'm investing in another country. So I have to look for the political, that geographical, and the human resource of that area. For example, if I invest in another country and I didn't do a clear analysis on all of these things, if the money gets lost, it's all up to my fault, not any other faults. So next is a settlement risk. So settlement risk is the chance that one or more parties won't fulfill their obligations. So for example, if party A cannot fulfill the obligation or cannot perform as expected, so obviously the party B cannot get his work done. So on one kind of counterparty risk is settlement risk, which includes timing inconsistencies between parties as well as default risk. So operational risk are the type of risk that may occur during the operations of the organization. And then model risk is a type of risk, I'll tell you. It just depends on the business model. So if the business model has been designed right, it will be a very smooth flowing operation for the business. Then there's the people, the or people working in the organization. If their demands and safeties are meet, it won't cause an harm to the organization and the workflow of the business. Then comes the legal risk. For example, it can be said as the breach of contract is one of the most common type of legal cases that the businesses face. Then we're going to the political risk. Of course, if you are doing business, there are going to be certain political pressure regarding those area. You need to meet those, or you need to come to a settlement. If that doesn't work out, it is going to definitely hamper the overall production of the business. Then we're going to the concept of return. So if we're doing an investment, we are definitely expecting some return. So it may be in the mutual funds or FDs, it depends, but it's always on the return. So we can calculate the rate of return by there's a simple formula. It's called the current value subtract original value divided by the original value multiplied by 100. So by using this formula, we can calculate the rate of return. And expected return are actually done by the investors, so that they can expect that they are getting X amount of return. It is done before they are doing the investment on any portfolios. So next off, I would like to take this. I think Anisha, you can take over from here.
Yes. Can I present the screen?
Okay, wait a minute. Just give me a second. Okay, is it visible? Is
One
is
second.
it okay?
I meant, can I present the screen so that
Yeah,
it's
yeah,
easier
sure,
for
sure,
me?
sure, sure.
Sorry. Okay, is it visible?
No,
Now?
yeah, it's
No.
visible.
Okay, so now we have successfully covered the scary part, the risk. And now that we have understood what risk and return is, how do we choose among this? Like, how do we make a choice what risk we should take and what return we should take? So, making a choice it is what can be called the most basic definition of trade offs. And trade offs are a part of our daily lives. It's not just limited to finance. Like, me choosing to watch Friends over my studies is me making a trade off between learning and leisure. But in finance, trade offs are more serious, more important, like choosing to spend over coffee today or saving that money for your post retirement. But no, genuinely, if let's say you don't spend 200 rupees on coffee today and instead put it in a savings account with let's say 7% interest, you'll after 20 years that 200 rupees will become 700 rupees. But if you do spend it on your coffee today, that will be the opportunity cost. The 700 will be the opportunity cost that you will be paying for making that trade off. So, how do you decide that what trade off you should make? Before we delve into that, I would first like to explain the four types of trade off. First being risk versus return. So, this is the most common type of trade off you face in finance. Let's say you are trying to invest something. So, if you deposit all your money in a savings bank account, you'll earn a low return, but all your money will be insured up to a certain amount. However, if you invest in equities, that same amount, you face a little higher risk, but um, you'll also get a chance to earn a higher return. So, will you jump in the pool of money, or it depends on how much of a risk loving or a risk averse person you are. The second type of trade off is liquidity versus profitability. This is very basic. It's basically you deciding how much money you want in your hand and for your daily spendings, that is coffee, and how much money would you like to invest to earn profit or return, let's say for your retirement. Every trade off obviously has some risk involved. For example, people who invested in crypto are not only risking it crashing, but also paying a 30% tax to the government for it. That is the cost they're paying for choosing this trade off. Next up, we have cost versus benefit. Basically, that involves deciding whether to spend more money or pursue a cheaper option with fewer benefits. Let's say you spend 300 rupees on a Starbucks, that gives you more utility, but you can also split that money into 200 and 100, buy coffee from that 200 and invest that 100 rupees into a savings account. These choices depends upon what is higher, the cost of choosing that option that you have, or the benefit you're getting from choosing that option. Next up, we have efficiency. Efficiency addresses the question of how well the economy's resources are used and allocated. In contrast, equity deals with how society's goods are and should be distributed among its different members. A trade off between these two happens when maximizing the productive efficiency of the market leads to less equitable wealth distribution. Now that we have seen the types of trade off, let's see what factors you should consider while making these trade offs. Sorry. First of all, you should be well informed. Uh, Now, since it's the IPL season, I thought it would be fun and easy to understand using an example of that. Now, for those of you who don't know the context of this image, it's pretty simple. So, Gujarat Titans set up a pretty decent score in the match where they were playing against the Kolkata Knight Riders, and they were almost going to win. It looked like they would win, but that's when the batsman, Mr. Rinku Singh, came and hit five sixes in a row, stabilizing the run rate. So, to draw a comparison here, you might feel like, hey, the company's share have been doing pretty well lately. I should invest in this. But you should know that you never know when a Rinku Singh might happen and it can crash. So it's important to consider other factors like checking the company's financial statements and be well informed before making any investment. Then next is you should be clear on your own financial goals. For example, if you have 1 lakh rupees and you want to buy a house, then you should use it for its down payment. But if you want to save it for your retirement, you should invest in a way that you get highest returns in the long run. A good way to decide your financial goals are to evaluate the opportunity cost of every choice before making it. For example, the choice of you betting on RCB in every match, you will that will not only lead you to losing money, but also you'll have to pay the opportunity cost of using that money to celebrate when it finally wins once in a blue moon. But yeah, so you should evaluate the opportunity cost of every choice you're making before investing your money. Then another important factor is your risk tolerance, how much of a risk lover you are or a risk averse person you are. Now imagine sleeping with the knowledge that the price of your stock went up, but waking up to it crashing. Now, if this thought sends a shiver down your spine, then you are a risk averse person, and it's better if you invest in a safer option like putting your money in a savings account. Last and a very vital factor is to consider that the economic environment is very fragile. The exchange rate can go down as fast as it went up, the market can crash anytime, and inflation can erode the value of your investment anytime. It's exactly like the anxiety you have before exams. It can go up, down, left, right. You never know. It's literally like a roller coaster. So you should always plan in before that the investment you're making, if that does not give the return that you expected it to give, what will you do then? So you should be clear on that financial goal as well. To conclude, basically, trade-offs are a very important aspect of financial decision making because they help us understand and make a proper choice as to what risk are we willing to take and what return it is going to give. Using effective strategies such as diversifying your investments, using hedging, and distributing it different investment instruments, and seeking professional advice can help us make the best decision possible. Thank you.